Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So if you're new to the channel, then I cover stock market investing, company analysis and personal finance tips as well. So in this week's video, I'm going to cover why you should buy stocks when everyone else is selling them. So let's get on with the video. So we want to be able to buy a stock when it's actually on sale. And by getting in at a lower price, that means we kind of take in less risk because we're spending less money on the stock. And it also enables us to get like larger gains once the stock goes up. So it's important to kind of understand how price kind of changes with stocks. So in very simple terms, it's just about a balance of who wants to buy something and who wants to sell something. So if a lot more people are wanting to sell something, then there is downward pressure for the stock price to go down because lots of people are trying to get out of the stock. So each time someone tries to sell it, they kind of have to go to a lower price in order to be able to get rid of the stock faster because there's not enough buyers for the stock at that price. So we'll go and have a look at a couple of Warren Buffett quotes now because these are kind of really interesting and give you some great insight to how he's invested throughout his career as well. So the first one we can see is that opportunities come in frequently. When it rains gold, put out the bucket, not the thimble. So what Warren is saying here is that when you get the opportunity, you need to kind of invest big when you get the chance because the chances don't come along very often. So rather than if the chance comes and just put a small piece of money, rather than that, you need to kind of go in big with your money when the price is kind of right for you. And let's take a look at the second one now. So be fearful when others are greedy and greedy when others are fearful. So this is where the title of the video comes in. The price of a stock drops when people are fearful, and this is when we need to be brave and buy in while the majority of people are trying to get out. So really good companies don't go on sale very often, so we have to be ready with our watch list when that happens. Now there's a number of different steps we have to take before we get to the point of being able to buy. But the first thing we need to do is kind of look at the different steps to invest in, and then we can actually go and look at the price as well. So when we're buying something on sale, we need to know what the fair value of it is anyway, or else how would we know that it's on sale? So this is kind of one of the important elements when we're looking at different stocks as well. Waiting for the sale is really like the last step we take before we make the investment. All the other work has been done previously to understand the business. So I'm going to go take a look at another slide now, which is going to show the steps leading up to this point. So first you need to invest in a company within your circle of competence. You really have to have a full understanding of everything about that company before moving on to the next stage. So I follow Phil Town quite a lot. I did one of his courses as well. So he has the 4 M's approach. So this is the meaning, moat, management and margin of safety. So this is kind of the approach I also take when analysing stocks or businesses to invest in. And the second point is moat. Obviously, the company should have a distinct competitive advantage that protects it from the competition. And that will allow it to kind of grow profits over time to kind of keep the competition away from it. The next point is management. We need to have management with integrity and talent who are honest. We don't want anyone who's kind of just out for themselves. So it's important that the management values align with your own values as well, and that they're kind of looking to grow the company and benefit the shareholders rather than benefiting themselves. So once we get to the next point, which is we need to calculate the intrinsic value and then make sure we have a margin of safety on that price. So normally we want to have a margin of safety of at least 50% because this is going to allow us to actually make mistakes and in the valuation of the company and still get out without making a loss. So the most important part of this is that we don't lose money. That's why we need to have a large margin of safety, and 50% is a good amount to have for this. And then the final point is we need to wait for an event to put the company on sale. So in the next slide, I'm going to go over the different types of events that we look for. So the first type of event is a company-specific event, and the example we're going to go and look at is the E. coli outbreak at Chipotle Mexican Grill, which was back in 2015. So now we're looking at the stock price for Chipotle Mexican Grill back in October 2015. So we can see on the screen here that the initial outbreak was on the 19th of October. The stock price at that point was $718. And we can see that only like a few months later, 3 months later in January, the stock price had dropped to $404, which is a drop of 44% in 3 months. So that's quite a significant drop. Now, the important thing about this is that you, like I mentioned before, you understand the business and you can be certain that the business is going to recover within 3 years. Because what will tend to happen is if the institutional investors see that the stock is dropping, they will get out of it because they have to kind of make profits in their next quarter. So if they see an event like this, they will think, well, there's no chance that this company is going to be posting profits in the next couple of quarters at least. So I'm out of there. So that's why it's kind of important to understand the business enough to know that it's going to recover in 3 years. So in this case, you can look and think, okay, maybe you've analyzed the management in thorough detail and you believe that they're going to rectify the problems and it will only take maybe 2 years to recover. So that's kind of comes from the thorough understanding of the business. And now we're going to go and look at the next type of event, which is an industry specific event. Now for this event, I'm going to use the example of BP, which had the Deepwater Horizon disaster, which was in 2010. So that happened in April 2010. And obviously that was a major environmental disaster as well. But for the purposes of this, obviously I'm only looking at it from the actual perspective of the stock price. So we can go and look at this now on the screen. So we can see the price in 2010. The actual disaster happened on April the 20th. So we can see here the stock price is at $60.48. And then we go to June the 28th, which is just a few months later. And we can see that the price has now dropped to $27. At this stage, they still hadn't fixed the leak and it was still going on. And during this time, there was also a number of class action lawsuits as well. So this shows a drop of 55.3% in 2 months. Now, the interesting thing here is it wasn't just BP and their subcontractors who got caught up in that. It was the whole oil industry in the US as well. So it was this particular event for BP was actually having a large effect on the oil and gas industry as well. So there's a couple of other companies, which is ExxonMobil and Chevron. We'll just see like how their share price also got affected by the disaster as well. So we can see the first day of the disaster, the stock price of Chevron is $82. And then just a few months later in July, it's kind of dropped 18% to hit $67. Very similar story for ExxonMobil. The first day of the disaster, stock price is just under $69. And then the price dropped 18% to hit a low of 56.57 on the 2nd of July. So that's a good example how other companies within the same industry can also get dragged in with an industry event. And now let's go and look at the final type of event, which is a macroeconomic event. Now this is an event such as the global financial crisis or the dot-com bubble or even the beginning of the pandemic this year. That is kind of an event which encompasses kind of the whole economy of either a country or a region or the entire world. So at this point you see shares and stocks all over the world like plummeting, just kind of going down. Nothing the company's done, it's just a kind of larger event which is taking place in the world. Now these are our favorite type of events because fundamentally probably not much has changed with the company. You just know that maybe they're going to suffer a little bit in the short term, but obviously every company is dropping. It's nothing particularly that the company has done. So I think it's good now to go and take a look at how the Dow Jones kind of fared earlier this year. So we can see that the Dow Jones Industrial Average hit an all-time high of 29,551, which was in February the 12th, 2020. And then we can see that only just over a month later, the price has dropped to 18,591.93, which is a decline of 37% in a very short amount of time. And Amazon is one of the companies that fared really well during the pandemic, but they still got caught up in the price dropping when the pandemic first happened and before the stimulus package came in. So even a company like that who's making constant profits and growing really fast is actually caught up in this macroeconomic event. So Amazon hit its own all-time high on the 19th of February, which was $2,170. And then we can see that by March the 12th, the price had dropped 23% to $1,676. So that affected Amazon quite a lot in the short term. But we can see that it bounced back quickly and recovered and has now been hitting new highs again. So now let's go and have a look at the key points from the video. So firstly, we need to ensure that we thoroughly understand the company we want to invest in. We also need to know the intrinsic value and our margin of safety price. And then we need to wait for an event to put the company on sale. And aside from this, we need to be certain that the company can recover from the event within 3 years. And if all those things are good, then we're ready to make the investment. And once we've invested, we need to regularly review the company, ensure that nothing has fundamentally changed in the business. Because in an event, sometimes the event might be so extreme that it damages the company beyond repair. So we need to make sure that we keep an eye on it and that the company is actually recovering. And the point here is that's why we have a margin of safety price, in case we get something wrong and actually the company's been fundamentally kind of damaged by the event. So our margin of safety should allow us to still get out without making a significant loss, or ideally any loss at all. So thanks for watching the video. I hope you enjoyed it. If you did, please hit like, and also consider subscribing to the channel if you haven't already. That way you can get notifications of when I release new material. This is usually like once a week, but I'm going to try and increase my content in the coming weeks as well. Also, please leave any comments. I'm always interested to know what you think about the videos and like how I can improve them, or what your opinions are as well. So please leave the comments down below and I'll get back to you on those as well. So thanks for watching, and I'll see you in the next video. Cheers.